So, welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. We're going to be mixing technicals with fundamentals. We're going to be having a heavy part on monetary policy as we have the Fed's interest rate decision, the late American session today. And during tomorrow's Asian session, we're getting BOJ's interest rate decision. Nevertheless, we're going to be going through major FX pairs if we have time. We could go through also some key US indexes, and I wouldn't be surprised to see some time for gold, maybe even oil, WTI this time. Should you have any trading instruments you would like us to have a look at on a technical basis, definitely, please note them in the chat box, and if we have time, we can look at them tomorrow. If not, we can always look at them today. Now, starting with Euro USD, we note a sideways motion. Now, I'm highlighting Euro USD as the main pair for the Fed's interest rate decision because we have diverging monetary policy outlooks here. On the one hand, we have an ECB which is expected widely by the market to continue cutting rates, and at this point it was characteristic that even ECB President Lagarde had highlighted the prospect of further easing. If I'm correct, she had noted on Monday that the path is clear and the direction is set. So, on the other hand, though, we have the Fed's interest rate decision today. The bank is expected to cut rates by 25 basis points. That's widely expected by the market. It's characteristic that Fed funds futures imply a probability of over 90%. If I'm correct, it's at 96.4 for such a scenario to materialize. And should the bank cut rates as expected, our main attention will be turning towards its forward guidance. Now, the forward guidance is going to be split into two parts. The first part will be the written part in the bank's accompanying statement. The second part would be practically oral and would be the Fed Chairman Powell's press conference, which is to start half an hour after the release. There is a third element which we would be keeping an eye out, would be the new dot plot. The new dot plot is going to be showing us where Fed policymakers are expecting interest rates to land at the end of 2025 and 2026 and beyond. And the last part would be the bank's macroeconomic projections. Now, if we analyze practically all five elements and we make a start with the interest rate decision, which is expected to cut rates by 25 basis points, as we have mentioned, the forward guidance, the market expects the bank to pause its rate hiking path in the January meeting. So should we see the forward guidance more or less verifying the market expectations for a rate cut pause, maybe even extend that pause in the one afterwards, then we may be seeing some support building up for the US dollar, as that would be perceived as a hawkish element. Similarly, should the new dot plot indicate that Fed policymakers expect interest rates at the end of the next year to land at a higher level than what the market is expecting according to Fed funds futures, that could also be perceived as a hawkish element and provide support for the USD. And lastly, should the macroeconomic projections, especially about inflation and employment, show a resilience of the US economy and probably a resilience of inflationary pressures in the US economy, that could also be supportive for the USD. Now, the interest rate decision as such is expected to be extended or provide extended volatility. And I'm highlighting this because we have the interest rate decision, but after half an hour, get Jerome Powell's press conference, which usually lasts around 1.5 hours. So we may see the volatility for the US dollar being extended for about 1.5, maybe even 2 hours. That's one. The other element I would be highlighting here would be that the decision could have ripple effects beyond the FX market. We may see the decision affecting US stock markets, and a possible more hawkish decision than what's expected could actually weigh on US stock markets, as it could also weigh on the precious metal gold. On the flip side, should the bank show less hawkishness than what the market expects, that could more or less weigh on the USD substantially, while at the same time it could be supportive for US stock markets, as equity traders will be seeing the possibility for further easing of financial conditions in the US economy and growth opportunities, thus spurring more confidence and a buying interest. Now, regarding Euro USD, we have some financial releases from the Euro area today. Allow me to have a look. And we are filtering the calendar practically and adding a number of countries which we are interested in. Give me a sec, please. I'm just about there. Sorry. That should sum it up. Now, in today's European session, from the Eurozone, we had already the final HICP rate for November. There was a tick down from the preliminary release from 2.3% year on year. It dropped to 2.2%. It slowed down to 2.2% year on year. The question mark is whether that had a bearish effect on the euro or not. We're drilling into the 1 minute chart. Unlocking it. No. You can see the time of the release right here. It was no major market reaction. There was some a few minutes later, but it was minimal. It was about 5 pips, nothing much. So readjusting the chart, going back to the daily chart. Here we go. Once again, we are highlighting the Fed's interest rate decision as a possible market mover for Euro USD, as it could be for the whole FX market. Now, should the Fed actually issue a more hawkish interest rate decision supporting the US dollar, then we would expect Euro USD to fall, breach the S1, 1.0470, and start aiming, if not breaching, also the S2, 1.0330. On the flip side, should we see an interest rate decision which would be weakening the US dollar, then we may see the pair breaching the 1.06 R1, practically paving the way for the R2 1.0760. For the time being, we maintain a bias for a sideways motion to be maintained practically between the S1 1.0470 and the R1 1.06. The RSI indicator is actually a bit low. It's at 41. And that tends to imply some bearish predisposition on behalf of the market for the pair. On the other hand, note how the Bollinger Bands have narrowed and seem to be flattening out. That would be signaling low volatility for the pair, which could allow the sideways motion as prementioned and prementioned boundaries to be maintained. Once again, unless there are major surprises which could rock the Euro USD in Fed's interest rate decision, we may see the pair maintaining a sideways motion. Other than that, chances are for a possible bearish movement should the US dollar actually strengthen from the Fed's content. Let's have a look at USD JPY. Now, USD JPY is expected to be hit with a double whammy, as we have the Fed's interest rate decision in today's late American session, but I would be also highlighting BOJ's interest rate decision during tomorrow's Asian session as a possible market mover. And at this point, I would be a little bit of a contrarian. Okay, let's start with the basics. The basics are that the bank is expected to remain on hold. And it's characteristic that JPY ORS currently imply a probability of around 82-84% for such a scenario to materialize. So there is a relatively wide expectation of the market for the bank to remain on hold, keeping rates unchanged. I'm going to be diverging here on this one. I set the base scenario for the bank to remain on hold, but I see the risks related to the release as tilted to the upside. So if there is a divergence, possibly the bank will be hiking rates by 25 basis points, not the other way around. And to tell you the truth, I'm a bit worried that BOJ may take the markets by surprise. And I'm basing this practically on comments which were made by BOJ Governor Wetter, but also a number of other policymakers. There seems to be a predisposition towards a rate hike. And even if the bank tomorrow remains on hold, the bank would be practically kicking the can down the road. The chances for a possible rate hike in its January meeting will be increased. So let's see what scenarios could play out here. On the one hand, would be that BOJ remains on hold tomorrow, and then the attention falls on the forward guidance. Now, should the bank remain on hold and issue a rather hawkish forward guidance in an effort to prepare the markets for a possible rate hike in the January meeting, that could provide some support for the JPY. Should the bank, on the other hand, remain on hold but issue a neutral or dovish forward guidance, which in my opinion is very remote, but it's still a possibility, then we may see the decision asymmetrically weighing on the JPY and causing USD JPY to rally. The third scenario would be what would happen should the bank actually hike rates by 25 basis points, practically taking the markets by surprise. In such a case, we may see the JPY getting asymmetric support and USD JPY tumbling. I wouldn't be surprised to see such an interest rate decision having a wide effect, possibly even below the S3 and onwards. Now, What is the most likely scenario? In my opinion, the most likely scenario is that the bank will remain on hold, keep the rates at 0.25%, but issue a more hawkish forward guidance, which could actually provide some support, a little bit more moderate, but still some support for the JPY. And I would like to highlight here a different aspect, which is usually not so much talked about. I'm expecting the bank to use the interest rate decision as an opportunity to actually make an oral market intervention to provide some support for the JPY, because it's already at low levels and against the US dollar, and it's weakening even further. And it's characteristic on a technical level. If we see the movement, we saw how yesterday USD JPY dropped, okay, but it dropped breaking a 1, 2, 3, 4, 5, 6 winning streak. For 6 continuous days, the USD was strengthening over the JPY for either ground, whether the US dollar was strengthening or the JPY was weakening. The end effect was for USD JPY to reach quite high levels. Now, it corrected lower yesterday, and I'm highlighting here that the price action has broken, at least temporarily, the upward trend line which has been guiding it over the past 6 days. So that's something which tends to imply that the pair may be stabilizing for a very short period, up until at least the Fed's interest rate decision. And then we may see volatility kicking in and being extended up until the Asian session tomorrow, when we get BOJ's interest rate decision, which could add to the volatility. Should the two interest rate decisions play out as described, then we may see the Fed's interest rate decision hawkish cut, practically supporting the US dollar, pushing USD JPY higher, while a possible hawkish on hold on behalf of BOJ could once again push USD JPY to lower grounds. It's going to be an interesting next 24 hours, in my opinion, for the pair, which may experience substantially more volatility than before. Let's have a look at GBP USD. Now for GBP USD, we had a surprise. And before we start, allow me to switch the R1 1.2675 resistance line into a support line, given that the price action has broken above it. And let's also readjust the labels and correct their contents. The R2, which is being placed now at 1.3040. And the R1 at 1.2845. The S1 at 1.2675. The S2 at 1.2515. And the S3 at 1.2290. 2295, sorry. and locking everything in. Now, over the past 2 days, we had two financial data releases which were of quite an interest for pound traders. And the first would be the release of UK's employment data, primarily for October, albeit there were some elements of the UK employment market for November as well. The unemployment rate, the employment change figure, and the average earnings growth rate for October tended to highlight a tightness in the UK employment market, primarily on two factors. The first factor was the fact that the employment change figure did not drop as widely as expected. So the UK economy seems to be providing or creating new jobs, which is a positive. My surprise came in with the average earnings growth rate, which accelerated beyond expectations and tended to highlight the possibility of the UK employment market actually continuing to feed inflationary pressures within the UK economy. So that's the one with the release, and let's have them look at the market reaction at the time of the release, drilling into the 1 minute chart, unlocking the chart, widening it, and let's go back. Here we go. We see how the tight employment market of the UK provided support for the pound, causing practically cable to jump around 25 pips upon release. And we're talking about 1, 2, 3, 4 minutes here. There was additional support and it stayed relatively at high levels or at higher levels for a considerable amount of time. So that was the one issue which tended to be affecting the pound's direction. The second would be the release of UK's inflation data for November. They were released during today's European session, and more or less there were, as expected, maybe slower. And let me explain myself here. I'm highlighting three indicators. The first would be the headline CPI rates for November on a year-on-year level, which remained practically or came in as accelerated as expected, at 2.6% year-on-year. The second would be the core CPI rate on a year-on-year level, which did not exactly accelerate. It failed to reach the targets met, also the targets set by the market. And the third would be the PPI rate on a month-to-month basis. The PPI rate on month-to-month basis remained flat. It failed to accelerate. Those outcomes tended to weigh on the pound, and they weighed understandably in the following sense that it was slightly less bullish than what the market expected. And if we see at the time of the release, the market reaction was very obvious. Further down, here it is. You can see how time of the release fell on a maximum of around 16 pips. But after some stabilization, it restarted to fall in deeper and remained at relatively low levels for the next 2 or 3 hours. So now if we sum up the UK employment data for October in combination with the CPI rates for November, I'm expecting the releases to enhance the BOE's decisiveness to remain on hold in its interest rate decision tomorrow. And I may also add here that the fact that the CPI rates accelerated on a year-on-year level at a headline rate and to a lesser degree also the core rate. That would be, in my opinion, reasons for BOE to express further doubts about any rate cuts in the general meeting. So they may cause a more hawkish BOE in tomorrow's interest rate decision, which could be mostly bullish for the pound. However, we have a deeper look on that tomorrow during the presentation release of BOE's interest rate decision. On a technical level, back to the daily chart, readjusting it, locking it in. Now, we maintain a bias to prevail with the price. We can see it revolving around 1.2675. RSI indicator has neared the the reading of 50, implying a relevance regarding the pair's future direction. So the sideways motion remains. Now, bullish outlook, I would require a higher peak than this one. So the price rise, breach above the R1 1.2845, which would be paving. On the flip side, for a bearish outlook, I would require a higher chosen. So the price action has to fall, breach the 1.2675, but OBS to 1.2515. We are talking about a fall of around 200 pips outlook to start emerging. And even then, it wouldn't be as clear as it wouldn't have yet provided the relative lower peaks and lower chows to start forming a downward trend line. So once again, I remain in a sense for the time being. However, once again, the Fed's interest rate decision tonight in the American session and BOE's interest rate decision tomorrow in the mid to late European session could actually provide a new direction for cable. Now to use the CAD. Use the CAD in a clear upward motion. We maintain a bullish outlook for the pair. Once again, a key issue for the pair's direction would be the Fed's interest rate decision, and a possible hawkish could provide support for the US dollar, pushing USD CAD higher, as maybe even increase caution on behalf of the market, which could on the Louis, which is considered as a commodity currency as of riskier nature. Oil prices remain rather flat despite some slight bearish. Let's have a look. Yeah, nothing much. So practically, they would, in my opinion, fail to actually provide any rule in the Looney's direction. Had the release of Canada CPI rates, they were yesterday, and the headline slowed down. Interestingly enough, also the core rate slowed down. They both ticked down. And that was another indicator which provided support for USD CAD as it weighed on the looning side of the pair. Interestingly enough, I would like to see what the actual market reaction was at the time of the release. Drilling to the 1 minute chart, unlocking it and going back. So there was no major market reaction. It was a small candlestick green, but note how the release quickly allowed for USD CAD to rise over the next 1 hour. It was very evident. It stabilized in the midst of the American session. Okay. Back to the daily chart. Once again, we maintain a bullish outlook for the pair. I would be adding a word of caution on the technical level, and that would be the fact that the price has reached the upper Bollinger Band. Note how it's flirting, which may slow down the bull somewhat. Also, I would be noting the RSI indicator, which has surpassed the reading of 70. It's actually right now at 75, which tends to imply a strong bullish market sentiment, which could push the pair higher. On the flip side, as a word of caution, a reading of the RSI indicator above 70 tends to imply that the trading instrument is at overbought levels and may be ripe for correction lower. But as long as the upward trend line, which was initiated on the 30th of September, remains intact, our bullish outlook remains. So even if USD CAD drops and remains above the upward trend line, the bullish outlook is still there. On a fundamental basis, probably should the Fed sound hawkish enough, it could provide renewed support for the US dollar and push USD CAD even higher, i.e. breaking the R1 1.4340 and starting to aim for the R2 1.45. Let's have a look at AUD USD, which should be in a downtrend, and it is. It's like USD CAD in reverse. We have a downward trend line instead of the upward trend line we have for USD CAD, which began also on the 30th of September and has been guiding the pair lower ever since. I'm noting here once again that there is a strong bearish sentiment leading the pair lower, which is evident by the RSI indicator, which is at the reading of 30, i.e. implying that there is strong bear, also warning about the possibility that the pair is at or nearing oversold levels and be ripe for a correction lower. Should the bears maintain control, I wouldn't be surprised to see the price action correcting a bit higher, given that it has also been touching the lower Bollinger Band, testing it, flirting with it, breaking the S1 0.6270, and start aiming for the S2 0.6160. Once again, the Fed's interest rate decision is considered to be key of the essence for the pair's direction. So we'll have more news after Powell's press conference. Actually, we have a better understanding the pair's direction. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
Okay, hi everyone. Welcome to today's webinar. Today's session, we are going to be talking about the smart money concept, trading strategy. So let's just go ahead and get right into it. So as per usual, a risk warning and disclaimer, our products are traded on margin and carry a high level of risk. And it is possible to lose all your capital. These products may not be suitable for everyone, so you should ensure that you understand the risk involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and the risk tolerance have not been considered. IronFX is not responsible for any loss, including from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so I'm Melanie and I'll be your speaker for today. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. We are going to do a brief intro to SMC and then ICT, because SMC is a kind of an extension to ICT. So we'll do a brief intro to that. And then we'll look at order blocks, breaker blocks, fair value gaps, and how exactly to use SMC in your trading. Okay, so if you guys have any questions throughout the webinar, feel free to pop them into the chat. Yeah, and let's go ahead and get started. So what is SMC firstly? So smart money concept is basically a way of trading that focuses on what the bigger players in the market are doing. So it was, like I mentioned earlier, initially popularized by an infamous trader who's also the founder of the ICT or inner circle trading, which is claimed to be the evolved version of the SMC. So SMC helps us to see where these big players are investing in. And the reason why is because these big players, which are often called the smart money, these include large institutions like your banks and your hedge funds who have a lot of money and can a lot of money and power to influence the markets. So SMC helps us to see where these big players are buying and selling so we can follow their lead and make better trading decisions. So the core concept involves replicating the trading behavior of these influential entities with a specific focus on variables such as supply, demand dynamics, and the structural aspects of the market. So now let's talk a bit about ICT and what we mean by it. So inner circle trading, which was originally created by Michael Huddleston to trade the forex market, uses the same strategies to profit in all and any market that they trade, focuses on understanding the inner workings of the financial markets. So it involves analyzing market dynamics. So you can see it's pretty similar to SMC, analyzing market dynamics, supply and demand zones, utilizing price action analysis. Yeah, so pretty similar to what we saw earlier with SMC. So why is it important for us to understand ICT first? So in today's highly volatile and competitive financial markets, having a deep understanding of how the markets operate in terms of the chart technical analysis, your price movements, support and resistance levels, order blocks, so on and so forth. These can help us to understand how the markets operate and can give us a significant edge as traders. So by mastering the ICT techniques, you can then enhance your ability to identify high probability trading opportunities and effectively manage your risk. Okay, so what smart money looks like in price action of terms which replace support and resistance, reversals, and volume. So some key components of SMC would be your order block, which is your supply and demand. We'll give you some examples of all of these in a little bit. So the order block, which is your supply and demand, you have your breaker or mitigation blocks, which this is what is traditionally called your supply, support and resistance. And then your mitigation block flips zones. We're not going to touch on that too much today. And the FVG, which is your fair value gaps. So we'll go through some of these in a bit. These are basically imbalances in the market. So basically when demand outpaces your supply or vice versa. And lastly, we have your liquidity grabs. So similarly with ICT, the key concepts that they use are pretty similar as well. You can see we have the liquidity, displacement, market structure shift, inducement, fair value gap, again, optimal trade entry, and order block. So you can see there's a lot of similarities between your SMC and your ICT. Okay, so let's firstly go through the key concepts in ICT, because I find that it is a little bit more structured compared to your SMC, which kind of just focuses on following the big players in the market. You know, these are more, I guess, things that you can actually work on and understand from ICT. So firstly, we have liquidity. There are two sides of liquidity. So there's the buy side and sell side, and secondly, there is the buy side liquidity. So where short sellers will have their stops position, your sell side liquidity is just the opposite. So buy side liquidity represents a level on the chart where your short sellers have their stops positioned. Sell side liquidity will just be the opposite. Okay, so let me show you an example here. Okay, so you can see your buy side liquidity is basically the area where there are two swing highs. Sell side liquidity will just be where there are two swing lows. Now, smart money players will understand the nature of this concept of liquidity, and they will accumulate or distribute positions near levels where many stops reside. But what I mean by that is where there are many swing highs or swing lows, basically. So the amount of stops at that key level then allows a larger player to fully realize their position. Once the level at which many stops are placed has been traded through, it's often that the price will reverse course and head in the opposite direction, seeking liquidity at the opposite extreme, like we see here. Okay. Now liquidity pool manipulation, it basically refers to areas on the price chart where significant clusters of buy or sell orders are located. These liquidity pools act as markets for price as they represent zones of substantial market interest. So these zones I guess similar to what we've been using as our confluence areas, but in this case, we are talking about buy or sell orders that have um, areas where there are many buy or sell orders. So by identifying these liquidity pools and understanding their significance, you can then anticipate potential price movements and position yourself accordingly. Okay, the next concept is displacement. So displacement is a pretty powerful move in price action that results in strong selling or buying pressure. So generally speaking, displacement will appear as a single or a group of candles that are all positioned in the same direction. These candles typically have a large real body and very short wicks, suggesting very little disagreement between the buyers and sellers. So often a displacement will occur just after a liquidity level, like we see here. After a liquidity level has been breached and will often result in the creation of both a fair value gap and a market structure shift. Okay, we'll get into what those are in a little bit as well. So you can see here the displacement levels that we've highlighted come just after these swing highs and swing lows, which you can see previously we did mention as our liquidity areas. So now let's talk a bit about market structure shifts. So the main concept with regards to market structure is just the overall trend. So if it's an uptrend, obviously the price is making higher highs and higher lows. If it is a downtrend, the price is making lower highs and lower lows. Okay, so here's an example. You can see in this example, we have our swing highs and swing lows that I've highlighted in this example. So this is just pretty much an example for your uptrend and your downtrend. Okay, here's a very obvious market structure shift. And here you can see we also are using a um trend line, a descending trend line, which basically means that there are at least three touches on this trend line to show us that there is a descending, or rather a downtrend with regards to the market structure. So pretty straightforward for this concept. Now let's talk about inducement. So inducement basically involves the price bounce or a rejection in which price will then target a previous short-term high or low before continuing in the same direction as the longer-term trend. So it's specifically, so here in the example, we're talking about how a price rarely moves in a straight line. So within a larger trend, there's always counter-trend moves. These counter-trend moves are always the results of lower time frame liquidity hunting. So inducement is specifically targeting these short-term highs or lows as areas where these stops might be placed. Okay, so you can see here, our market structure shift starts about here. Here, when price breaks below this swing low here, so we can see this downtrend start. Okay, so there's an uptrend once there is a recognizable switch in the shift of the market structure that's giving us our market structure shift, which starts about here. The inducement starts when there is a swing high, short-term high rather, not really swing high, that then reverses off and hits to create kind of like this kind of shape, like price is dropping or there is a rejection of this area that we see. Okay, so in these areas, we can expect to place our stops right after the inducement areas. Now let's look at fair value gaps. So these are gaps in the price chart where there is a sudden jump between two price levels, often because of a big move. So these gaps can be like unfilled areas on a map, and the market doesn't like these gaps, and prices often return to fill them. Spotting these gaps can help us to predict where the price might retrace or go back to. So, yeah, here our example is that it's created within this displacement and are defined as instances in which there are inefficiencies or imbalances in the market. These imbalances are visualized on a chart by a three-candle sequence containing one large middle candle whose bordering candles' upper and lower wicks do not overlap. Now, I'll show you what we mean here. So this is an example of a fair value, which basically describes an imbalance in the market. So you can see from our first example here, I guess, um, the price kind of departs from a specific level with limited trading activity over here. So it results in a one-directional price movement. You can see this uptrend forming. So here we have an uptrend, but in the case of a bearish trend, the FVG would represent the price range between the low of the previous candle and the high of the following candle. So basically the opposite of this. So this area would reveal kind of a discrepancy in the market, which may indicate a potential trading opportunity. Okay. So yeah, here's an example of a bearish trend. Okay, so you can see after price reaches the liquidity level, which is basically your swing highs or your swing lows, and then it reverses off of it, it then becomes a displacement. So then the fair value gaps are created within this displacement, and are defined as what we talked about earlier, the gaps in the market or inefficiencies in the market. So earlier I did mention about the three candle sequence. So you can see here, that there often it is visualized by on the chart by a three candle sequence containing one larger middle candle whose bordering candles upper and lower wicks do not match or they don't overlap. Okay. Okay, so those are the key concepts for our ICT. So if we go back to our SMC trading strategy, it's pretty similar in terms of the concepts. I think they pretty much just use different names. So here, introducing break of structure. This happens when the price moves past a significant level on the chart. So it breaks through a previous high or previous low. And this indicates that the current price is, or the current trend is continuing. So, okay, maybe in this example, you can think of it like if the price has been moving upwards or yeah, in this case, you can see a slight uptrend. If we look at the first breakout structure, there's a very slight upward movement. So if the price has been moving upwards, it breaks above this previous high, which is this high here. It shows that buyers are still in control and the upward trend is likely to continue. Right? So this breakout structure shows that it's going to continue upwards. If we look at this downtrend here, price is this is the swing, kind of the swing low. So then from this swing low, price broke below this level. So we are expecting prices to continue to break below this level. It's pretty straightforward once you kind of understand it. So basically, if the price is moving downwards, like it is here, price breaks below the previous low, which is here, shows that sellers are still in control and that the downward trend is to continue, which is what we see here. Okay, now these are often used together with our change of character. Again, both of these concepts are pretty similar to some of the ICT concepts that we mentioned earlier, but it's just kind of a different name for SMC. So change of character occurs when the market shifts from one trend to another, indicating a potential trend reversal. So it's like a signal that the market's behavior is changing. So for instance, if the market has been in an uptrend and it starts making lower highs and lower lows, it suggests that the trend might be reversing to a downtrend. So the opposite is also true. If a downtrend starts making higher highs and lower lows, it might be reversing to an uptrend. So here you can see the first example, price breaks above this higher high, so we're expecting it to continue in an uptrend. Here we see a potential trend reversal in which there is a swing low here, price breaks below it, so we're expecting it to become a downtrend. So the reason why you can kind of see why we use change of character with breakup structure, but I'll show you here. Um, okay, it's kind of I use the same image. But okay, if we refer back to our breakup structure here, okay, so this is our breakup structure. So, but to be able to identify where our breakup structure would be here, right? You can kind of see it would be at this level here. Okay. And if we were to look for another breakup structure, it would be, as we mentioned earlier, from a swing high. As long as price breaks above that higher level, that previous high, that would be here, right? So there's a breakup structure here. Okay, but if we look at another breakup structure, probably be this swing low. Price breaks below this previous low. So this is another breakup structure here. Let's see if there are any other um BOS that we can identify, I think probably here as well. Okay, when there is a swing high here and price actually breaks out of this swing high level. So that's also a breakout structure. Okay. Um, are there any questions so far? I would draw it in, but there's something wrong with the pen on my computer, so I won't be able to draw on the screen. But basically, to reiterate, your breakout structure for this chart would be here, since price is breaking above the previous high. Um, the last one would be here, since price is breaking above this level. And I think there's one more that we identified was over here. So swing low, price breaks below this level. Okay. Yeah, so I'll get into the entry and exit points in a little bit. But yeah, let's just continue. Yep, you can use it with other indicators as well. In fact, we actually do encourage you to use all of the strategies in combination with other indicators so that you kind of get an idea of whether your analysis is correct or wrong. Um, you know, normally we would have about 4 to 5 indicators that we know how to use, are comfortable using, and then after your technical analysis, then we use our indicators to confirm our analysis. Okay, so let's talk about order blocks, and this is similar to, I think, somebody's question about entry and exit zones. So, basically what an order block is it signifies a concentrated area of limit orders awaiting execution. So these are basically the levels where we discuss supply and demands. So I guess it's kind of similar to your support and resistance levels and how to identify them, which we will get into in a little bit. But basically, an order block is identified on a chart by analyzing past price movements for significant shifts. So these zones serve as a pivotal point in price action trading, influencing the market's future direction. And when a multitude of buy or sell orders cluster at a specific price level, it establishes a robust support or resistance capable of absorbing pressure and triggering price reversals or consolidation. So now let's talk a little bit about support and resistance and how to identify levels to for entry or exit. Um, okay, we would normally use support and resistance levels, significant levels for your pivot points, which would be your entry points. Okay, so these obviously refer to a level at which an asset's price tends to stop falling, which would be your support, or stop rising, which would be your resistance. So it is basically important for you to identify these levels. You can use it using technical analysis tools like your trend lines, moving averages, chart patterns, and your swing highs and lows that I've done over here. So you can see what we call as swing highs and lows. In our previous examples, you can see that how we use that in your SMC as well. So this is pretty much just basics that allow you to expand to other trading concepts. So picking a starting point, so you want to make sure that you pull it back as far as possible, so that you can see how significant these levels are. Okay, so you can see here where the green thumb is, this is a swing high, but where our orange thumbs are, it's kind of it's an all right level. But it's not great because it's not a significant enough swing high or swing low, and there isn't really it cuts a bit too many bodies of the candlesticks. So for example here, you can see where the red thumb is cutting too many candlesticks. It's not you want to make sure that you have a really clean cut, something like this. Okay, some more examples here, clean cuts. This is a bit too messy. So we would just stop our entry level from over here. Okay, now the pullback and overlap concept is very similar to your SMC concept as well, where we talked about price overlapping or surpassing the previous high. So for pullback support, it's a strong level of support where it breaks out from the previous resistance level and price is now dropping back to visit it again. So when the pullback support lines up with a Fibonacci level, it is very powerful. So we'll talk a bit about Fibonacci at the end as well, because this also touched back on a SMC concept on maybe yeah. So I'll just say for your SMC, the entry actually they encourage you to enter at the 61.8% Fibonacci level. So it's good if you can have a Fibonacci level that lines up with one of these support or resistance levels so that you have a really strong level of support or resistance. Okay. Yeah, so here's an example. You can see at the red area, we have price testing this level 3 times with multiple swing highs in line with that level. Once price breaks out of the red area, it becomes a pullback support, and we expect price to pull back or retrace to this level from the dotted arrows. A pullback resistance would be when there are 3 swing lows or 1 swing low even, and price breaks below that support level. Once it breaks below the support level, it then becomes a resistance because we're expecting price to retrace off that level. So this is what it'll look like on an actual chart. So we have a swing low here. Price surpasses our swing low support, then now becoming a pullback resistance, and you can see price pulling back to that level. And we're using this in combination with our Ichimoku indicator, because like I mentioned earlier, we want to make sure that we use as many indicators as we can that support our analysis. Okay, so we can see price kind of bouncing off of the Ichimoku cloud. So that in combination with this pullback shows that we might be seeing price bounce off of this level. So once price reaches this level and reverses off of it, it then becomes an overlap resistance level. Overlap level is when the bulls and bears respect that level to take note of. You can see in this GIF, it basically occurs when price touches from the top and from the bottom. Okay, so it shows that prices respect this particular area, and the more times that it reacts off this area, the stronger the overlap area. Okay, so again, if the overlap area lines up with other graphical elements, such as your Fibonacci or your graphical elements, it will make it even stronger. Okay, so swing low support becomes a pullback resistance here once price breaks the support at 105.643 in this example. So here we can see how price retraced or pulled back to this resistance level and reversed off of it, making it now an overlap resistance. Okay. Okay, so now let's combine both of these levels so that we have really strong resistance and support levels, which can also be used as your entry levels, take profit levels, so on and so forth. Okay, so in this example, we have a big swing high resistance level. Price surpasses this level and becomes a pullback support where we expect price to um, pull back or retrace this level and it bounced off of it perfectly over here. So we're expecting it to pull back to this level here. So price has made a pullback to our pullback support level and has bounced off of it perfectly. And once price bounces off the pullback support, it then becomes an overlap support. Okay, another example, we have two swing highs that line up, the purple circles. Okay, and price has surpassed this level and has become a pullback support. So we can expect price to retrace to this level. Take note of the blue circles here. Price bounces off this level twice, making it a strong overlap support. Okay, last example for pullback and overlap levels. So here there are multiple swing lows that are in line at the 33420 support level. Once price breaks below that level, it becomes a pullback resistance at point number 2. Number 3, price has pulled back to our resistance and has reversed off of it 3 times. So since price has tested this level 3 times, it makes it a strong overlap resistance level. And then it happens again where price pulls back above that resistance level. So it becomes a pullback support, and then it retests our support level, making it an overlap support. So pretty straightforward. If you are able to identify these kind of levels where there are many times where price tests that level, that's a good sign that it's a significant level to take note of as an entry point or a take profit level. But if you can combine those levels with your indicators like pivot points, Ichimoku, or even with your Fibonacci levels, that would be even better. Okay, so now let's go back to our SMC concepts. Okay, actually these are ICT concepts. Okay, we firstly have the optimal trade entry, which represent the best places to get into a trade. So according to ICT and SMC, the best places to get into a trade or your entry levels are utilizing the Fibonacci between 61.8 and 78.6. So I'll show you how to use your Fibonacci levels in a little bit in case you are unfamiliar. And another key concept is balanced price range or imbalance, which is the result of an aggressive move up that's immediately followed by an aggressive move down. Okay, or the other way around, where an aggressive move down is immediately followed by an aggressive move up. So what's left after either of these instances is essentially a double fair value gap, which we talked about earlier, and can act as a magnet to the price before a continuation moves higher or lower. And balanced price ranges can sometimes signal the beginning of a market structure shift, which again we talked about earlier, and the price can often retest and reject from these areas. Okay. Now let's briefly talk about Fibonacci and how to use it in order to enter at your 61 and your 78. Okay, so here's a very simple Fibonacci retracement checklist that you can use. So firstly, we want to check is the market structure clear? So a way to identify this clear market structure is by looking for big zigzags. Number 2, you want to identify the recent trend. So is price going up or down. Number 3, identify the recent major swing lows and recent major swing highs. And number 4, to connect the two extreme points. So the highest to lowest would be for a downtrend and lowest to highest would be for an uptrend. Okay, so here's an example on the charts. So you want to make sure that you follow the price structure closely, which is why I'm taking it from here to here. And here you can see my 61.8 lines up with this area. You can see price bounced off that level perfectly. So this would be a good area for you to enter over here, especially according to our ICT, where your entry levels are 61.8 and 78.6. So another level here, but this time we're using 38.2. You can see how this 38.2 is also in line with a previous swing high and actually a swing low here as well. So this is what we mean by combining um, overlap levels or your pullback levels together with your Fibonacci. So we firstly will identify this is a swing high, swing low, which means it's an overlap level. But this overlap level also lines up with a 38.2 with the lowest point, the starting point here, ending point here. And therefore we can identify that price is likely to rebound off of this level again. Okay, which is exactly what happened here. Okay, in this example, we have two Fibonacci retracements that are being used. So the first one is our big Fibonacci retracement. So price reverses off the 61.8 over here, the swing high. Okay, and we actually have another swing high in that same area. So we have a double swing high as well as a 61.8, which makes it a significant level. Next, we have another retracement, a smaller retracement with the starting point here and ending point here. This time again 61.8, and we have two Fibonacci, or rather two swing lows that line up with this Fibonacci level. So we can expect price to rebound off this level and hit towards this this area here, where the double swing high was before. And also in line with our 61.8. Okay, I think that's pretty much it. If you are unfamiliar with Fibonacci, this is obviously just a small part of it. We are just going through really the basics of Fibonacci retracement. For ICT as well as SMC, you are mainly looking at the Fibonacci retracements. Okay, just as your entry because of the 61.8 and the 78.6 that they recommend. But there are 4 different Fibonacci techniques that we like to use. So if you've missed our Fibonacci webinar, stay tuned because we'll probably do those again soon. But basically, in the meantime, you can look up this website. It's just forexarmy.com. We have a bunch of trading guides as well that are completely free for you to use. Today I'm using this one. Okay, how to draw Fibonacci retracement correctly. We have some free YouTube videos for you to take a look at as well. What to look out for, some guidelines, how to identify a clear market structure. But the most important would probably be these on how to identify your confluence areas. So confluence areas are basically areas where 2 or more Fibonacci levels line up together to create this area, this Fibonacci confluence area as we call it. Reason being, these confluence areas tend to attract price really strongly, and price might not be able to push past that level. So we might see a price reversal off of those levels. So that's why it's important for us to be able to identify them. Okay, so we have some trade management techniques as well that you can check out. I'll just pop this website into the chat if you're curious as well. Okay, yeah. Again, it's completely free to use. Yeah, this just for Fibonacci's, the different Fibonacci techniques, because I don't have time to go through all of them today. Okay, so I'm only talking about the one that is recommended by your SMC, which would be these, the retracement. Okay, so super basic, taking your retracement, your Fibonacci tool from the highest point to the lowest point. Yeah, and then seeing where the levels line up or where prices have in the recent past reversed off of those levels or have tested those levels. Okay, pretty straightforward. Okay, so how to use SMC in trading. So it's all about being able to spot these key areas on the chart and making decisions based off what we see. So here's just a simple plan that you can use. Firstly would be to identify order blocks. So you want to look for areas where the price consolidates, which means move sideways before a big move up or down. And these are your potential order blocks. Next, you want to watch for breaker blocks. So you want to notice if the price returns to an order block and breaks through it, indicating a new trend direction. Number three, you want to find fair value gaps. Look for sudden jumps in the price market or the price chart, which can indicate where the price might come back to. And number four, plan your trades. So you want to use these areas to decide where to enter or exit a trade. For example, you might enter a buy trade at an order block or set a sell target at a fair value gap. And number five, combine with your other tools, like your other indicators and analysis methods to confirm your decisions and manage your risk effectively. Okay, so what time frame should you use SMC? So the choice of time frame for SMC is completely up to you as a trader and based on your goals and your own strategy. So SMC recommends short-term traders to trade on a 1 hour to 4 hour chart for quicker insights, while longer-term traders might opt for daily or weekly charts to capture broader market trends influenced by institutional movements. Okay, that's pretty much it for today. Yeah, let me know if you guys have any other questions about SMC or your Fibonacci. If not, that's pretty much it from me for today. Yeah, but yeah, I'll stick around for a while in case you guys have any other questions. There are a lot of websites out there as well, on how to use your smart money concept, um, or your ICT, inner circle trading. So feel free to just Google it and check out the websites online as well. I'll stick around for a while in case you guys have any questions. But if not, you guys can go ahead and leave. Oh, we can't share the slides, but this webinar is being recorded, so I think the recording might be available. Um, yeah, feel free to just email IronFX as well. They should be able to help. If you just email them and ask for the recording, they will be able to help you out. I'm not able to send the slides on on your email, so you have to email them. Let me see. Let me see if there's an email I can find. Yeah, I think I'm just gonna pop it into the chat. Yeah, so you can just ask them for the recordings and they'll be happy to send it over to you guys. Okay, if there are no other questions, yeah, that's it for today. Thank you guys so much for joining me. I hope you guys found this session helpful. If you guys like me, feel free to add me on LinkedIn as well. It's just my name. It's just Melanie Chong. And yeah, I'll see you guys again next week. Thanks, everyone. Bye.